Okay, good morning, everyone. Thank you for joining us for August's Shariah Pulse session. My name is Verlyn Troskie. I'm the head of retail distribution for Sentio Capital Management. And I'm joined this morning by the head of our Shariah Solutions, Imtiaz Suliman. And if you've attended one of these sessions previously and you haven't received your CPD points, don't worry, we're working on it. It just happened to coincide with that time of the year when you had to renew your CPD provider status. As soon as that was done, we submitted for the previous months of CPD points. So if you actually participate in the session and you have to be here for the full 30 minutes, then you will get your half a CPD point. That's our undertaking on our side. So we trying to aim to add a little bit of value by giving a bit of a market update, and then we just round up at the end with a little bit of insight into what Shariah investing is, what underpins the principles, because I don't think it's a market that's well understood, even though it's a market that's actually got a lot of potential. So we're going to give it another minute or so, because we always have people that log in just a minute or two late, and then we're going to start at 9:33 sharp, and then we'll probably finish at 10:02 sharp. So that's half an hour on the nut. Thank you.
Right.
Okay, so let's get this right. Okay, so good morning, everyone. To those that I didn't say good morning, let's get the session underway. My name is Verlyn Troskie, head of retail distribution for Sentio Capital Management. I'm joined this morning by Imtiaz Suliman, who's the portfolio manager for our Shariah Solutions set. And this is our monthly pulse session. Aim of the session is to update you on the market, one or two of our stock picks, a contributor and a detractor. And then I'll round out the session by giving you some advice that you may or may not know that you can implement in your practice or share with your clients. In that way, we try and add a bit of value to your practice. If you're in for the whole session, the full half an hour, you will get half a CPD point. That's our undertaking. So at the end of the year, we try and add about 10 sessions in the year. You should have 5 technical CPD points. So over to you, Imtiaz, and thank you for your assistance this morning.
Thanks, Verlyn, and good morning to everyone. Thank you for joining us today for this Pulse update. As Verlyn said, we'll go through a bit of a market review for July and the year to date, just to sort of cement and get an idea of what's happened so far. July has been an interesting month, whereby it was another strong performance for equities in particular. As you can see that the all share was up 3.9%, and a large part of that was driven by the resource sector, which was the sector that outperformed during the month of July. Resources were up by 5.6%, and if you look at it from a year-to-date number, resources are up 10%. That's been driven by mainly gold shares. Gold has been a strong performer year to date with regards to the underlying metal itself. And the shares, if you look at the likes of a Harmony, Anglo Gold, they're up close to 50% year to date, and it's been a very strong performance. In the resource sector, there's a bit of a mix between the different counters, with some of the single commodity names like iron ore, PGMs lagging, and that's been countered by the strong performance in the gold shares. From a financial perspective, that's been a very strong performer year to date, up 14.3%. A large part of that has been driven by the likes of Capitec, which is up 41% year to date, and some of the other banks which have also performed quite strongly. Bonds would have given you 9.8% year to date, and a very credible performance on the month of 4%. And industrials has been a bit of a mixed picture. There's a lot of different subsectors within industrials. You've got the telecom sector, you've got the luxury goods sector, you've got the healthcare, construction, etc. So it's a bit of a mixed bag, but some of the strong performance within industrials has been the clothing retailers, the likes of a Mr. Price, Truworths, Fushini, all performing strongly for the year, and some of the laggards being the likes of the telcos, with MTN and Vodacom not performing as strongly. And then lastly, cash. Cash has given you just under 5% year to date, with 0.74% on the month. Before I get to the stock contributors, I would just like to touch on some of the macro factors. And these macro factors have been a common theme throughout the year. And I think it will still be a common theme going forward until we get some certainty on, rate cuts in the US and the rest of the world. Just to put into context, some of the major economies have already started cutting rates, like the Bank of Canada, the ECB, the European Central Bank, and they've, preempted the Fed. The data coming out of the US is a bit of a mixed picture, and we'll talk about some of those factors. Just with regards to inflation, the US inflation has dipped now below 3% after peaking at over 9%. And now the conversation has shifted towards whether we're going to get a 25 basis points cut from the Fed or a 50 basis points cut in September. And I think it's still very much in the balance and very much data dependent. We still have one more jobs number prior to the September Fed meeting. And that's going to be a key determinant of whether we get a 25 basis points or 50 basis points cut. Certainly, the inflation outlook is on a downward path. I think the Fed has its dual mandate with regards to making sure that prices are stable, but also unemployment doesn't fall off a cliff. And that brings me to the next point. The unemployment numbers have started to weaken. We've seen the labor market weaken to some extent. It's not showing signs of red warnings yet, but this is the challenges with monetary policy. Monetary policy acts with a lag, and the Fed has a balancing act in terms of making sure that liquidity conditions are sufficient, not to stifle the economy, but also not to cause massive inflation. So this is a key component into the rate cut cycle that we're going to embark out of the US. It's very important because once the Fed starts to cut, that will ease some pressure for emerging markets in particular, in terms of them also cutting rates. We've seen our own central bank opting to hold rates stable at their last meeting. But once the Fed starts cutting, that will give them some leeway to also pull the trigger on cutting rates. Global growth is pretty much stable, but has come down from the highs post the COVID boom that we saw. The one area of concern is China in particular. We've seen the data come out of China that has been a bit on the weaker side, and the Chinese government has taken the decision not to stimulate that economy to a large extent. The consumer in particular is quite weak in China. We've seen housing prices come under pressure, and a lot of household wealth in China is tied to property prices. So that's been one dampener on global growth, although the likes of the US and the rest of the world are holding up quite, quite positively. Geopolitics is always a fluid situation. We've had the war in Russia and Ukraine now continuing for over 2 years. We've got the conflict in the Middle East as well. And we've seen, certain flare-ups around the world from time to time. I think this is something that's very difficult to predict, but it's also something that we need to keep a close eye on, because if things start to escalate, you could see oil prices in particular moving up, which would put pressure on inflation and again would cause the Fed to be cautious in cutting interest rates. So that's a summary of our macro view. In terms of, there's a lot of talk. Are we going to get a recession in the US? Is it going to be a soft landing? Is it going to be a hard landing or a no landing? So what you see there in those three columns there is the different scenarios and the probabilities that we put to those different scenarios. On the right-hand side is the hard landing scenario. In brackets is the probability that we had last quarter. We saw that at a 30% probability. We've now moved that up to 40%. And the no landing scenario has moved down from 60% to 20%. And a soft landing scenario has moved up from 10% to 40%. The reason why we've shifted our view from the no landing scenario not being our base case is because we've seen the data starting to weaken out of the US, but we've also seen that the Fed is very much willing to cut rates, and also the market is sort of bullying them to cut rates faster. And I think this is something that's going to play out over the coming months. So what are the different outcomes for these scenarios? If we look at the hard landing scenario, that would translate into a global recession whereby earnings start to decline and central banks would need to cut rates aggressively. Some of the key drivers of that would be a very poor reading from employment numbers out of the US and Chinese stimulus that doesn't come through as much as the market expected. That would cause the dollar to strengthen, equities to sell off, and developed markets to outperform in that scenario, with a particular style favoring growth and quality. On the left-hand side, a soft landing scenario is something that is still very much on the table. And this is a scenario whereby global growth slows to trend, inflation declines to central banks' targets, which is 2% in the US, and company earnings still manage to grow, although modestly. The Fed would be able to cut rates in that scenario. Inflation would come down to that 2%, and that would be very positive for emerging market currencies, a bit negative for the dollar. You should see equities outperform the likes of fixed income, and then cyclicals will do better than defensive from a style perspective. Value would outperform growth and quality. And then lastly, the no landing scenario, is where global growth remains quite strong. We've seen signs of global growth weakening, hence our reduction in that probability. But that would mean, the dollar remains quite strong. Equities would do okay in that scenario. And again, from a style perspective, growth and quality would outperform value. I'm going to dive and spend a few minutes into one of the stock contributors for the portfolio that's done very well for us. it's Mr. Price. And what you can see there is the share price movement year to date. Mr. Price has moved from 150 Rand to 216 Rand to the end of July. As you know, Mr. Price is a very strong cash generator in terms of its operations. It has a good market positioning in terms of the different segments that it plays in. Mr. Price Apparel is a very strong player in the value segment of the clothing space. They do generate good returns on their capital, and they generate and it translates a lot of that returns into cash. Hence, they've got an ungeared balance sheet with a strong cash balance. It's a high growth company that was very attractively priced, and that's the reason why we've held quite a significant portion of the portfolio in Mr. Price. Over the years, it's been a strong value contributor, and we've traded it as the valuation has gotten full and trimmed it as we've seen value. So Mr. Price has had an excellent run year to date. It's up 41%. What you can see there is that it's reaching close to our fair value, and the upside has reduced considerably, with it just being 4% at the moment. It's something that we would look to deploy into other shares or counters that we see better value, but Mr. Price is still one of those quality counters that we currently hold in the portfolio. Just some of the key drivers and the metrics that you see in front of you. This is the results of Mr. Price to the end of 31st March 2024. And although the macro environment in South Africa always seems challenged and has been challenged, the company has managed to grow sales by 15.5%. They've managed to increase the cash balance to 2.8 billion Rand. And that is despite Mr. Price making quite a few acquisitions in the last few years. The latest acquisition has been the acquisition of Studio 88. It's a retailer that sells athleisure wear, the likes of sneakers, clothing, etc. And it was quite a big acquisition for Mr. Price. But despite that, because of the good cash generation that they generate, the cash balance has built up again. From a market share perspective, for the full year 2024, they've gained market share over their competitors. They've also managed to grow their gross margin by 20 basis points, and operating profit grew by 7.9%, which translated into an earnings growth of 6.7%. So what you can see is strong metrics coming through. We do think that the environment will get more favorable for the likes of Mr. Price, and that should support them going forward.
Good morning to you. How is you? Hey, small man.
If you
Just hold on quickly.
Good morning.
If you look at, there's been a lot of talk around online and the likes of the foreign retailers like a Shein and Temu coming to the South African market, and that's certainly having an impact on the likes of Mr. Price. But we don't think that impact is something that is going to, damage their business model quite significantly. What you can see is online is an important part of the retail channel. With regards to Mr. Price, online sales make up 2.1% of their total sales, and that's been growing quite strongly. A lot of the online sales are picked up in stores. Customers shop, place their orders online, and then go and collect in store, because then you don't pay the delivery fee. In terms of returning merchandise, it's much easier to go and return merchandise to a store rather than waiting for the courier to pick it up, or if you're ordering from overseas, there's quite a long time lag for that process to happen. So whilst we're not dismissing the likes of a Shein and Temu on the impact of the South African retailers, it's important to bear in mind that the retailers themselves have quite a strong offering in the online space, and their physical footprint gives them an added advantage over the pure online retail players. So for that reason, we do still hold Mr. Price. And it's something that's been a anchor for the portfolio in terms of its weighting. The returns have been fantastic, and we still think that the business model is very competitive in this environment. Thank you. I'm going to hand over to Verlyn to just take us through a few slides on Sharia investing, and then I'll come back at the end for questions.
Right, Imtiaz, let me just get all my things ready here. Just bear with me. I spent a couple of days in hospital, so I'm still getting my mojo back. But anyway, so let's quickly unpack Sharia-compliant investing. Everyone can see my screen. If you can't see it, please let me know, and then I'll help you with that. Already here. Okay, so let's just quickly talk about Sharia-compliant investing. I think what we've realized is that there could be some misgivings about what it is and what it is not. So let's talk about it and explain to you what it is. So first of all, I think the perception is that we always just talk about equity, but that's not the case. You also get Islamic fixed income instruments. They don't deliver yield in terms of interest income. They deliver yield in terms of profits. And if you then look further, you've also got Islamic structured products and derivatives. Now, you may not in South Africa have come across this because in South Africa, the market is not that developed. Yep, Imtiaz?
If you could just put it in presentation mode.
Is it not in presentation mode?
Oh, it's sharing the other screen. You could just change it.
Hold on quickly. Like I said, is it sharing presenter mode?
Yeah.
Oh. Okay, let me just take that off. It's going to stop sharing. So I'm going to restart sharing. Like I said, guys, just bear with me. Been to week in hospital. Take this off. Okay, there we go. Okay, so let's go. So in South Africa, I think we don't have all of these instruments. And if you look at our Sharia product offering, you will see that there are offshore instruments in it. But this is just to give you an overview that you can see that it's equity, fixed income instruments, and structured products and derivatives. So the market as Sharia is actually a very complex market. It does have all of the instruments that you do get in a conventional market. So it's not an undeveloped market in terms of offerings. And as the market's growing, you do actually then have more products become available locally and globally as well. So the key principles here, quite simply, it's riba. The earning or charging of interest is forbidden. So you will notice that everything in terms of Sharia investing earns profit. If there's an interest, there is a small percentage of interest that could be earned. If it's in excess of a certain amount, that has to be donated to charity. It means it needs to be cleansed. So, but that's forbidden. So you cannot earn interest. So you will not see a normal bond. In recent times in South Africa, they actually issued a Sharia-compliant bond. Doesn't pay interest. in terms of the yield. Then Garar is the major uncertainty is prohibited. So that's something that's very key to the sustainability and the stability of these portfolios, is that you cannot undertake investments in very uncertain or speculative, that's the right word, types of investments. So speculation is something that you will not come across in terms of Sharia investing. Then Maysir, that again ties into the above, where your excessive speculation is prohibited. So you do make sure that your investment is rather stable, that the potential for a positive outcome to both parties is actually on the cards, and then that leads to profit and loss sharing. So both parties need to share. One party cannot make a profit and the other party make a loss. That is just one of the underlying principles. And if you think about Western type of investments, where they call it a zero-sum game, one guy gains, other guy loses, that's a little bit different to the principles that underlie Sharia-compliant investments. So these are different principles. Normally, we get stuck on the types of investments that we cannot undertake, which we will look at just now. And then always asset-backed contracts. So there has to be a physical asset that backs your investment. Can't be a derivative thing that speculates, for example, in whether the weather is not paying off or the weather is not coming across, it's not going to rain, something like that. It has to be an asset-backed contract. So it has to be a physical, underpinned with a physical asset in terms of the contract. Some of the industries, and I think this is where most of us get stuck in our conventional space when we advise clients, is we understand the industries in which we do not invest. So obviously, pork products, firearms, any type of pornographic or adult material is not allowed. Gambling, obviously, that's not on. Banks earning interest, and then there are other industries that were also off charts. So this is normally where we get stuck. And we think this is sort of what Sharia investing is. It's just plainly simply, you cannot invest here, and that's sort of where it stops. So that's not the truth. The previous slide actually showed the principles that underlie it as well, apart from these types of prohibitions. So there's an actual very important screening process. So it's not just taking out your specific company. So there's an initial screening that underpins the whole process. Then there would be a financial ratio screening. So you'd obviously screen out the industries that are not applicable, industries and companies that are not applicable. Then obviously you would apply your normal financial ratio screening to make sure that the companies that do remain are actually investable. So here you would apply your normal financial ratios, your peer group analysis. So that step still forms part of the process. We then apply our qualitative screening. So that means we apply our fundamental analysis of the companies, our top-down macro analysis, and we bring that together. So you will see there's now 3 steps. And then last but not least, it goes to the Sharia board, and we have an independent Sharia board, and they will approve the investment. So we cannot just go and make changes to this and then say, okay, well, this is Sharia compliant. There is a process that underpins the putting together and the managing of a Sharia portfolio. So you have your initial screening, industries allowed, companies that make the cut. You do the normal financial ratio screening. We do the normal investment process. And last but not least, to make sure that it's all okay, it goes to the Sharia board for its approval. So what is the key benefit of this? Because of the fact that there's, for example, no interest charged, you normally wouldn't sit with companies that are highly leveraged. So these portfolios do give you high resilience in periods of volatility. So if we look at some of these periods, Sharia portfolios actually did outperform during all of these periods. And you can go and look, 2001, we had the dot-com bubble, global financial crisis. Obviously, there is a lot of things that was done that would not have applied. A Sharia investment would not have gone into a lot of this speculative investing that happened during the global financial crisis. Last but not least, post-COVID interest rate cycle, again, you would not have had the stress. If you think about it, a company like a bank that's highly leveraged, when you go into high interest rate cycles and all of a sudden you sit with all this interest rate risk, a Sharia portfolio would not carry that risk because you quite simply would not be in a company that's invested like that or that's structured like that. So all stakeholders considered, so everyone benefits. So just at the bottom, we can just look at some of this. So if you look, it's not just about, I think Milton Friedman called it profits at all cost. So profits at any cost. So as long as the shareholder made profits, the rest of the stakeholders were left out to dry. That's not the case in terms of Sharia investing. At the bottom are some of the tenets which we try and hold at. So zero hunger, affordable and clean energy, decent work and economic growth for anyone, industry, innovation and infrastructure, sustainable cities and communities, responsible consumption and production, and then peace, justice and strong institutions. Those are all considered when we go about our Sharia investing process. Right, so normally people would assume, quite simply, because your investment universe is slightly tapered, or in South Africa, you've got a bit of a small investing universe. Sentio applies a global investment process in our Sharia portfolios. We look globally for opportunities. But this just goes to show that the assumption that a Sharia portfolio generally underperforms a normal portfolio is not the case. If we look at the annualized returns over the last 10 years through March 31st, 2023, and we go back 10 years to March 31st, 2013, or that would be April 2013, that would be the first month. In total, Dow Jones Islamic World Total Return Index returned 12.98%. The MSCI All Country World Index, which is a peer group, would have returned 11.63%. So we cannot make the assumption that in general, Sharia products underperform conventional products. This is there for you to go and look and go and make your own comparison and see whether that still holds true to this day. Is Sharia investing exclusive to Muslims? No, it is not. This was a question that we answered at the FPI annual refresher. I think people have that perception because of the religious aspects. But besides the religious aspects that is important to the Muslim community, a lot of very healthy fundamental principles get applied when you do a Sharia investing process. Like the excessive speculation that's not there, the excessive use of interest, not backed by an underlying asset, hard asset, things like that. And then when you filter, you actually end up with a very strong fundamental base out of which to build a portfolio. Sharia investing is open for anyone to invest. And it potentially, if you want to diversify during periods of very high volatility, this could potentially be a solution that you could utilize. If you're that way inclined, you do not have to be a Muslim person of the Muslim faith to go into Sharia portfolios. And we've seen that's the case. These portfolios have been used by a great diversity of investors across the board. So just to wrap up, guys, if you have any questions, I'm going to give you time just now. How to keep in touch with us. We look forward to hearing from you. Visit our website. Request a brochure. Follow us on LinkedIn. Join us again for our Pulse session, August, September. We have Coffee Connect sessions. And then invest with Sentio. Sentio at this point, just in terms of our Sharia portfolios, we are very strongly positioned versus our peer group, and we are very well positioned in terms of returns year on for this past 12 months rolling. So if you have a Sharia client or a Muslim client that's looking for a solution, please look at Sentio. We are really in the mix quite strongly with our differentiated approach. Then obviously, if you have any questions, you're welcome to contact me and then I will help you with that. So let me just stop sharing, and then we can take questions. So guys, that's basically it. We're right on time. So if you have any questions, please, you can have a minute or two to ask, and Imtiaz will answer. This recording will be made available, and the next session that we hold, we'll set this up as a webinar. Teams actually now has that type of function, so it won't look like a meeting. It will be a bit of a more of a webinar thing. And if you attended the full session, you will get your half a CPD point shortly. Just be patient with us as we apply. So if there's any questions, please unmute and ask, and Imtiaz will answer. Guys, you're also welcome. If you don't want to ask, you're welcome to send me an email. Welcome to drop a question in the chat box. But I think we did well. Thank you very much for attending, Imtiaz. There's no questions. If there's some questions, I'll send them on to you. But guys, thank you very much for attending. I really hope we see you again next month. Sorry for my bit of a flip in the middle. Like I say, I'm actually still on sick leave. But we had to do the session to keep the momentum going. So thank you very much for attending. And I hope you all have a really great day and a good morning.
Thank you. Bye-bye.